For what feels like forever, the housing market has been, well, stuck. But something just shifted, and it's a big deal. Mortgage rates have taken a surprise nosedive, and it just might be the key that unlocks the whole thing. So, let's break down what this big drop really means for you. Here's what we're going to cover. First, we'll look at the new rate that's making headlines. Then, we'll translate that into actual dollars and cents. After that, we'll dive into the lock-in effect that's had the market frozen solid. We'll also explore what's behind this drop. And finally, we'll tackle the million-dollar question. Does this actually solve the affordability crisis?
All right, let's start with the number that has everyone talking. After years of climbing, the cost to borrow money has finally made a pretty significant move in the other direction.
And there it is. As of January 15th, the average 30-year fixed mortgage rate dropped to 6.06%. Now, I know that might not sound like a revolutionary number on its own, but trust me, in the world of housing, a move like this is massive. To really get a sense of how big this drop is, let's put it in perspective. We haven't seen rates this low since way back in September of 2022. And think about this. Just 1 year ago, that same rate was over a full percentage point higher, sitting at 7.04%. That is a huge difference. And this isn't just a number on a spreadsheet. It's already making waves. According to Sam Cotter, who's the chief economist over at Freddie Mac, the market is waking up. He says housing activity is clearly improving, and it looks like we're heading for a really solid spring sales season. Okay, so a 1% drop sounds nice. But what does that actually mean for your bank account? Let's turn these percentages into real, tangible savings. So let's do the math. Imagine you're buying a home for, say, $450,000. Last year, at that 7.04% rate, your monthly payment for principal and interest would have been a little over $2,400. But today, at 6.6%, that exact same payment drops to around $2,172. So what's the bottom line? You're looking at an immediate savings of about $230 every single month. I mean, that's a car payment, a big chunk of your grocery bill. That's real money back in your pocket right away. But here's where it gets really wild. You stretch that monthly savings out over the full 30-year life of the loan, and it adds up to nearly $84,000. That is just a staggering amount of money. Now, for the past few years, the market's been frozen by this thing called the lock-in effect. But these new, lower rates, they might just be the thing that finally breaks the ice. Let's take a look. So, what exactly is this lock-in effect? Well, it's pretty simple. Millions of homeowners bought or refinanced when rates were at historic lows. We're talking 2 or 3%. So, understandably, they haven't wanted to sell and give up that amazing rate for a much higher one. It basically trapped people in their homes and totally crushed the supply of houses for sale. But that whole dynamic is starting to change. We've actually hit a critical tipping point. For the very first time, the number of homeowners with mortgage rates above 6% is now bigger than the group with those super low rates below 3%. What that means is the incentive to just stay put is getting weaker for a whole lot of people. And you can already see the results in the data. Look at this. Sales of previously owned homes jumped over 5% in December alone. That's the 4th month in a row of gains, the longest positive streak we've seen since the middle of 2020. People are finally starting to move again.
So the big question is, why? Why is this happening now? What's actually behind this sudden drop in borrowing costs? Let's look at one key factor that's been highlighted in the reporting. One event that was noted is a call from former President Donald Trump to purchase $200 billion in mortgage bonds. The stated goal here was to directly push mortgage rates and monthly payments down, with the aim of making homeownership more affordable. And according to Susan Wachter, a professor at the Wharton School, these types of actions may already be having an impact. She says you can already see it in the data, putting what she calls a modest downward pressure on rates. So at least in the short term, this could be a contributing factor. Lower rates and a market that's finally moving, that all sounds like great news, right? But before we celebrate too much, we have to look at the other, much tougher side of the housing puzzle. And here's the big catch. While it's getting cheaper to borrow money, the houses themselves are not getting any cheaper. The median price for an existing home is now over $405,000. And get this, December marked the 30th straight month, that's 2.5 years,
of year-over-year price increases.
You know, this brings up a really fascinating point from Daryl Fairweather, Redfin's chief economist. She points out that a more active market has huge benefits beyond just affordability. When people can move, they can take a better job in a new city or find a home that actually fits their growing family. It helps the whole economy and just improves people's quality of life, even if the price problem itself isn't totally solved.
And that leaves us with this final central question. The market is finally getting unstuck because the cost to borrow is down. But the price of entry, the cost of the house itself, is still climbing. It really forces us all to reconsider what housing affordability even means today.